You can become an 8-figure entrepreneur with no money doing one of these mini roll-ups. Buy a bunch of companies, put them together. That creating of scale now gets me bigger. I'm going to trade for a higher multiple because larger companies are rare and they trade for higher multiples than smaller companies. Now I'm going to sell the combined entity for 8 times. My net proceeds are $27 million. I can build this model with no money down.
Welcome to another episode of Can You Make 9 Figures Doing This? Me and my partner, Adam Coffey, the man who sold $2.46 billion in exit, another $3 billion coming up, 58 company acquisitions. And here's the most important question. Can you make 9 figures or 8 figures buying and selling and putting business together without any money? The answer is, Adam?
Hell yes, you can, JT. Matter of fact, I'm here to tell you that these next 2 episodes that you and I do will be the most valuable podcast, video podcast, whatever we want to call it, episodes that we've ever done for the public.
Well, let's take this back, right? So we see a lot of things online where people saying you can buy businesses, with no money and make millions of dollars. So let's just maybe put this to rest. Is it possible? And maybe what are the myths of having? So yes, it may be possible, but here's what the public, the so-called wannabe gurus, or maybe they did 1 or 2 deals, but sustainably, can it be done? And maybe put your take on that.
Yeah, sure. JT, right now, I just counted this morning. I am working on 18 different buy-in builds, 18 of them, where we're doing exactly what the hell we're talking about. You and I are working on some of these, and so can it be done? Yes. So let me frame it up. There are certain industries and there are certain kinds of companies that make it easier to do this and to win. So we should probably cover that for just a couple of minutes. We've talked about it before, but pretty soon I'm going to actually get on some of my tools and I'm going to demonstrate what the heck I'm talking about. But let's just talk about what could we do to stack the deck in our favor, and right now, let's say we're an entrepreneur who's out there listening to us. We don't own a business today. Maybe we're working in the Fortune 500 world, and we're earning a good living. We're making some money. We've been doing some passive real estate investing, but not setting the world on fire lately. I want to do something new. I've been hearing about this, buying companies, rolling them up, putting them together, and I want to get into doing that. So I haven't bought anything yet. So with all the industries in the world that are out there, how do I pick one, to start? And so I've framed this up before. We've talked about it on podcasts. I put it in Empire Builder in the book. It's like we need to focus on needs, not wants. The economy moves in cycles. If I'm a business that's based on wants, my wife wants a new dress, because we're going out on Friday night. I got a truck. I want new Monster tires for my big ass 700 horsepower truck. But I have needs. I own a business. I need help bookkeeping, accounting, payroll. Because I'm an entrepreneur and I'm an operator. I'm not a finance guy. And so I need help, and I need that. I must have that because I've got to be able to report my revenue, pay my taxes, do whatever I have to do. If I'm sitting here in my office and it's raining outside and it's raining on my head and I'm indoors in my office, I need my roof fixed. Doesn't matter whether I'm laid off. Doesn't matter whether I'm not having, I don't have a bunch of money. It's like there are certain things in life we must have them. And so if we focus on needs, when the economy cycles down and we get into a recession, or even worse, if my business is focused on needs, I will be more resilient to a down economy because at some level, consumers still need the product or service that I've got. So we want to be needs-based. Next thing is we want to be recurrent, revenue-based. So think about, I live in Texas, there's big ass bugs out here. I need pest control because mama doesn't like bugs walking around in the house. So I have a pest control company. I sign a contract. I give them my credit card, and every month they hit up my credit card every month. And once a quarter, they come spray my house. And then they tell me, hey, Adam, we got big ass mosquitoes out here. I can add mosquito service. Okay. Yeah, great. Go ahead. Do it. Okay. Yeah. Okay, should I hit up the credit card we have on file? Yeah, sure, go ahead. And then they come back to me and say, hey, Adam, we got termites here. Would you like to add termite service? Oh, sure. Yeah, go ahead. Hit up my credit card. And hey, we have army worms and they eat your lawn. It's like, I should be spraying your lawn and I should be doing, these other treatments. And it's like, would you like me to do that? Yeah, sure. Go ahead. Should I hit up your credit card? Yes, please. Before you know it, it's like they're hitting me up for like $300 a month, $400 a month. And I just ignore it. I don't care. That's recurrent revenue. The hardest thing for companies to do is find a customer. Once they find a customer, then we want that revenue that we just found. First of all, we want to have a bunch of stuff to sell them, a bunch of different products or services, but then we want that to be additive to the customers we already have. Here's the problem with a project-based business. I made a lot of money in HVAC, as an example, and you can too. You can make money in any industry, as you know, but some are better than others. So like HVAC, if I'm going to sell you an HVAC system, you're going to buy one about every 12 to 15 years. It's a one and done event. My revenue this month is totally gone next month. I have to start from zero and find enough customers to replace the revenue that I had last month. That's a project-based business. And in a down economy, if it's discretionary, then that's even worse. So we need to find companies that focus on needs, not wants, contracted revenue better than project-based revenue. Finally, the last point I'll make is that low capital expenditure is better than high capital expenditure. So let me give you an example. That payroll bookkeeping accounting company that we're going to talk about in just a minute here, my product is in my head. I don't have to have a plant. I don't need a bunch of construction equipment. I don't need a bunch of things. I need some computers sitting on a desk. That's very low capital expenditure to build that business, which means it's very high free cash flow conversion. And if we don't have money and we want to do a roll up and we want to buy a bunch of companies and put them together, we're going to need to use the cash flow inside the business in order to service the debt that's required to buy the business. And so if I have a company that looks great on paper, it has really high EBITDA, high earnings, but it has massive capital expenditures, I don't have any free cash flow. So we want low capital. So I got needs, not wants. I've got contracted revenue versus project-based, and now I've got low capital expenditure, free cash flow. Tons of industries out there that meet that criteria. A lot of services type businesses would meet that criteria. Professional, even better than blue collar home services, but both do just nicely. And this is the profile. So if I focus on a profile and I get the right kind of company, yes, I can absolutely buy companies for a low price and then put them together, build a bigger company, get some synergies out of them, make it more profitable, and then I can sell it for a higher multiple because of this thing called arbitrage. So that kind of sets the stage for the types of industries that we need to focus on in order to be able to do this with very little to no money and make a ton of money in a relatively short period of time.
Well, let's maybe hone in here. I start off saying, can you do it with no money, right? So someone's watching this, let's say, and say, Lisa, I'm going to do this with no money. How would they go about doing it with no money? Obviously, there's the art of creative. Like I can buy real estate with no money, and I've done many of those. But obviously, it's a lot. I'm not always going to get the best properties, or in this case, the best companies creatively. And then on previous episodes, which I recommend everybody go listen to, episode 1 to 5. And you can go back and then you say, okay, well, you should not buy a messed up company to try and turn it around, because then you're going to spend all your time, taking this turd and trying to polish it up. And it's, so it takes a long time. So where's the no money come in? Forget the little money, but the no money, how would that be done?
Okay. So so we need to keep the price of the acquisition of the small companies that we're buying down. And the way we do that is by picking an industry that's highly fragmented. So if you don't mind, I am going to share my screen here, and I'm going to get us to a window I've got open. Here are 2 tools that I literally use every day. One of them is called Dun & Bradstreet Hoovers. So I'm going to give you an example. We're going to build a company list. So I'm going to hit get started. we're going to take a look at bookkeeping and accounting, payroll services, these kinds of companies. And so I'm going to come down here and I'm going to change, and we're going to look up based on NAICS or NACS code. And I'm going to put in 5412. This is accounting, tax preparation, bookkeeping, payroll service companies. And so I want to just point this number out up here, JT. So I put in this NACS code, and in the United States, there are 1.8 million bookkeeping, accounting, and payroll service companies in the US. That's a massive number. And when there's this many companies, then there just aren't enough buyers to make the prices go up. And so I happen to live, in Texas. So I'm going to put in a local zip code, and I'm going to say within 200 miles of where I'm at, which
Does it matter in a roll up, let's say in bookkeeping, can you make it all across the United States, or they prefer to have it targeted within one area?
If you're starting small with the first company, think about building a region before you worry about, so we don't want to buy one in Texas, one in Florida, and one in California. It's like, that would be a disaster. If you're going to buy and collect little companies, you want to build scale, you want to build density. So I would prefer to build a region first and then become a multi-regional company and then become a national company. And so I'm going to look just in within 200 miles of where I'm at up here in the Dallas-Fort Worth area, which would open up the Texas Triangle. So this would be Dallas, Houston, San Antonio. And so if I add this now, there are 15,159 bookkeeping and accounting firms within 200 miles of my house. That's a lot. So this fragmentation sets us up. And I could look at the results, and I can look at them by name. And here's all the different companies, that exist. And some of these will be giant, like Deloitte or KPMG. Here's a Deloitte, but a lot of these will also be small because there's more smaller companies than there are big. Now,
so how do they know what the sales are? How do they know what the sales are? Because I see these, some of these are private companies. So how do they,
So on this tool, I'm not looking at the sales numbers because I think they're wholly inaccurate. All I'm looking for with this tool is to identify the number of them that are out there. And so they're going to represent a lot of different, and if I click on one, I can go in, I get their website, I can go to their website, I get information about who owns it. So I ignore revenue and employees on this particular tool. So what I want to know from this tool is how many are there and where are they at? Now, there are other tools that are a lot more expensive than this. This one costs about $600 a year. I could buy a tool that costs $18,000 a year called Grata, and it would give me a ton of accurate information. I'm just using this to show if I've got no money and I got to keep it cheap. So if I have time and no money, I could use a cheap tool like this, identify the total population, and now I got a bunch of legwork to do. So I just got the phone book. Now I got to go through and figure out how big they are, if they're attractive, et cetera, because I've got time, no money. If I've got some more money, I could buy a more expensive tool. But now let's turn to valuation. So we got to know what these companies are worth. And so when I look at the same NACS code for accounting, tax prep, bookkeeping, payroll, here I find that in the United States, 276, of these companies have been sold in recent history. And if I throw out the bottom 25%, throw out the top 25%, I'm kind of looking at the arbitrage that's available to me. I'm looking at 2.6 to 7.2 is kind of a typical spread, and a median price being paid is 4.3. Well, as I told you, I'm doing 3 roll-ups and bookkeeping, accounting, and payroll services. And I've been loving what I've been seeing. I've been seeing companies that, on average may have, let's just say I find a company that's got 3 million in revenue, and it's got $1 million in EBITDA. And the free cash flow conversion, because there's no capital expenditure, is like 95, 98%. So essentially, I got 3 million in revenue and $1 million in free cash. That company is selling for about 3 to 3.5 times because there's just too damn many of them and not enough buyers to possibly buy them all at that size. And so I have been actively working in this space. And so let's use one of these as an example. So I've got 3 million, is the purchase price, and I'm buying $1 million of free cash flow. So there's multiple ways that I could purchase this. I could use some seller financing. Now, if I'm not a bookkeeper, accountant, if I'm not going to step into this business and run it, then I'm going to need somebody to run it. So I'm looking for my first anchor business, and my profile or the avatar I create for the first one is I want 3 million in revenue, $1 million in earnings. I want someone who's probably between 35 and 50 years old who's going to stay with the business. They're an expert in payroll, bookkeeping, accounting services, but they don't know anything about buy and build. They're going to partner with me. Maybe I'm going to have them roll over 30% of their proceeds, and they're going to become a co-investor or a co-owner with me. And so they're going to get a bite of the apple right now when I buy the business, and then they're going to stay invested, run the business. I'm going to buy a bunch more companies, put them together. That creating of scale now gets me bigger. I'm getting above the 1.8 million small ones, and I'm now becoming rare. I'm going to trade for a higher multiple because larger companies are rare and they trade for higher multiples than smaller companies. Smaller companies trade for low multiples because there's not enough buyers. Bigger companies, are rare. And so the numbers we've talked about before, 34 million small companies in the US, only 3,000 in the planet that have $1 billion in revenue. So as we get bigger and we're climbing up the pyramid, all of a sudden we're rare. We're above the 1.8 million small ones, and we're in a new territory, and people pay up for that new territory. So let's go back to our numbers. So I buy that first one, they roll over 30%. So I'm paying 3 million. They're going to roll over 900,000. Let's just make it round numbers for easy math because I'm not a math guy. So let's say they're going to roll over $1 million. So I need to pay them $2 million for this business. And they're going to become my partner in a new holding company that I just formed. And I'm going to buy a bunch of companies and put all the assets up into my holding company. So this first person is coming along for the ride. They're going to do what they do best. I'm going to buy companies close to them. They're going to run my business, and I'm going to get them another payday because they've rolled over alongside me. So I need $2 million, but I have $1 million in free cash flow. So if I look at the debt now and I say, okay, how much cash do I have and how much does it cost to service the debt? Let's assume I use 100% debt for that 2 million. So if I borrow $2 million at 10% interest, and I do it fully amortized for a 10-year note, I'm probably going to need about $350,000 in cash to service a $2 million note. But I'm buying $1 million in cash. So if I take my $1 million, divide it by the 350, I've got roughly a 3 times debt coverage ratio, 3 times debt service coverage ratio. So if an economy, it turns south, goes down, and this company loses 10, 20% of its revenue, I'm still going to have plenty of cash flow coming out of the business to service the debt. So all that's left to do now is I need to get financed. And so if I have this kind of a scenario, I have 30% equity. Even though it's not my equity, it's the equity of the seller. And he's my partner or she's my partner in the new business we're building. And so their 30% rollover becomes my 30% equity as well, because it's the holding company buying this little operating company. Now, I'll get back to financing in a second. So once I buy the first company, I call it an avatar. So the avatar for my first business is I'm not going to step into it and run it. I'm going to do the buy and build. I'm going to work on buying other businesses, putting them together. I'm going to be the higher level business guy. I'm not the accountant. This person's going to run operations. That's all they have to do. And so now, I've got them running the business. But when I now buy the second, third, and fourth business, maybe I change my avatar. Maybe I'm no longer looking for someone who's 30 to 50 years old, who's going to stick around for the ride. Now I'm looking for the guy or the lady who's 60 to 70 years old who would like to retire. And so that person's going to sell me their business. I'm going to focus heavily on seller financing. So they're not only going to get a bite of the apple when they sell me the business, but they're going to get an income stream coming from the debt that they're using to supply me the capital. I work on these all the time. I see founders willing to do anywhere from 10 to 50% of the purchase price, as a note, because as they're 70 years old and walking out the door, what they want is, yeah, I'll take $1 million of that purchase price now, and then I get an income stream for 10 years. And if you default, I take back my business and I sell it again. What a great deal. So I would focus on older for the second, third, and fourth companies, and I'd have, a higher component of seller financing. Going back to that first one, I might have them roll over 30%, but then have them also supply 20% seller financing. So I now have 30% equity in the business, and I only need 50% of the purchase price for debt. Now, I'll be honest, in a perfect world, somebody needs to have some freaking money. A lot of banks and lenders would like you to, even if it's a token, the numbers look
you can
great.
raise the capital. You can raise the capital. You go to
Sure.
partners, they say, hey, listen, I'll give you a piece. So the idea of no money down is you have to be able, you may not put any of your own money down, but you have to convince others to give you money. And just like I did my first 500 real estate deals without spending a cent of my own money, but somebody had to put money in there. In this case was I raised the capital. And so you have to be very good at convincing other people to bring him in, either by giving a percentage or a preferred return and a piece of the upside, or just a straight up loan, which is going to depend, on the type of deal and everything. So when we talk about this, no money doesn't necessarily have to be some of your own money, and obviously dilutes maybe your percentage of the profit. And so, but Adam, does the idea of like saying, I'm going to spend none of my own money, I'm not going to raise any money from anyone, right? In essence, going to buy this company, no money down, which in essence would be 100% seller financing. You're probably not getting a great company, right? Because someone who's making $300,000, $400,000, $500,000 in profit in their company, the likelihood of them just handing over the company to you without you putting zero money is probably very unlikely. Not impossible, but very unlikely. Correct?
Correct. But I will say this, if you think about the SBA, the Small Business Administration, there are loans that are geared towards people with not a lot of money. And there's many, many lenders who lend under SBA guidelines, and they don't all have the same type of underwriting criteria. If I walk into, a big bank institution and say, do you do SBA loans, and they say, oh, sure we do, but we require a 20% down payment. Okay. So if I need 3 million or 2 million, I'm going to have to come up with 400,000, 600,000. That's a lot of money. But just like when you buy a house, there are some lenders who say, I want 20% down. And there are some lenders who say, I'll let you get by with 5%, and there are some lenders out there who say, hey, the property you're buying below market value appraises really high. You have a ton of equity in it. That business looks good, throws off a lot of cash. I just need to see something. I need to see you come out of pocket with 50 grand, 100 grand, something. And so there's a lot of people in the world, JT, who would love to say, I don't want to sign any personal guarantee. I don't have any money, and I want to become a 9-figure entrepreneur in 5 years. Well, go buy a freaking lottery ticket, because that's, in life, we're going to have to take some risk. In life, if we don't have any capital at all, we probably shouldn't be buying a company. But if we did find one that met all of my criteria, there still are people and ways out there to get these things financed. I'm working with a guy in the collision repair industry who is buying and rolling up collision repair centers. And these are great businesses, and meet a lot of my criteria, not all of my criteria. But, I'm helping him buy them. And at the prices we're paying, he's getting a ton of seller financing. This guy is 26 years old, JT. He already owns 2. I'll help him buy his 3rd, his 4th, his 5th. And then when we get a little bigger, we're going to sell it to private equity. He'll keep building it because he's a young guy, but he's going to get his first bite of the apple. And then also at the same time, keep going, looking for a second bite of the apple. We've talked about that on other episodes. And so in his case, a lot of seller financing, and he is using SBA loans, but the hardest company to buy is my first. Once I buy my first, I now have equity. I'm in a like business, buying another like business. Now the bank not only looks at the cash flow of what I'm buying, they look at the cash flow that we have. They look at the companies on a combined basis, and very quickly the numbers start getting very, very attractive. I have a model on my screen. I mean, I could show you an example of what this could look like for somebody. And, so let's do that. I'm going to share my screen. And I'm going to
And while
share.
Adam is sharing the screen, especially if you want to listen to part 2 or any future episodes, make sure you subscribe and make sure you like and you comment. And if you want to do this with us, the link is in the comment, adamcoffee.com.
Yeah.
With your company or just as a deal maker, we are open to make this happen.
So this is not a perfect model, but I'll say it's a very directionally accurate model. So I buy this first company, I pay 3 million in revenue. It's got 3 million in revenue. It's got 900,000 in EBITDA. I'm paying 3.5 times for it. Enterprise value paid is 3.15, million. I set the seller rollover amount to 19% because the SBA will allow a seller to roll over 19% without guaranteeing a new loan. If it's above 19%, then the seller also has to guarantee the loan that's being used to buy out their business. And a lot of guys, that would be a bridge too far. So the rollover amount in this case is 598,000, and the seller financing is 20%, which is 630. That leaves a cash balance due at close of 1.9 million. And so in my little model here, I'm going to put equity in on the first 3 deals. 50% on the first, 30% on the second, 30% on the third. Now, this model is to buy about 7 companies. What I'm really doing is I'm trying to buy about 4 million in EBITDA. And so at the right, I'm going to buy however many companies it takes. If I could get away with buying 3, that'd be great. But I'm going to buy about 13.5 million based on the demographics for this industry. I should expect to have about 4 million in EBITDA. I'm going to pay 13.8 million for the companies. I'm going to have about 1.6 million rolled over by the sellers. My seller financing is 20% across the board, so they're going to provide me with that. I'm going to need 9.376 million cash at close to buy all of these. In this case, I'm putting equity in the first 3. It's 1.8 million. Now, JT, I could re-engineer this to where it was very little or no money down, but this is one that I'm going to do, and so I don't mind putting in a little bit of equity. But I could also go out and raise this equity. And so at any rate, I put in that as cash equity. I stopped putting in equity after the first 3 because there's diminishing returns on equity. If I want to juice up my returns, the highest value is created by putting some equity in up front. That's why I do it high in the first and quickly taper off and then end. And so by putting all this in, my cumulative revenue now, because I expect as I'm collecting these companies, I'm going to get some synergies. I'm going to focus on helping them grow because we do need to be a growth company. And so over the time period I put this together, I'm going to grow in total, maybe over a 3-year period, I'm going to grow about 25%, and I'm going to grow earnings from 4 million to 5 million. Now I'm going to sell the combined entity for 8 times. Enterprise value, 40,500,000. I got some transaction fees if I hired a bank. I've got to hire lawyers and et cetera. Of course, if I'm doing it, I know who I'm selling it to. I don't need all those fees. And then I got to pay off the debt. So the cumulative debt, which is the bank debt plus the founder debt, I pay all that off. My net proceeds are 27 million. And if I go back to the first owner who put in that little bit of equity right here, their payday on this, $20 million. The first seller who rolled over 19% of their business, they get 4.7 million. And so if I look at and I go over to the right here, there we go. So for the people who put up the 1.8 million right here, they get an 11 times multiple of invested capital. And the person that rolled over the 19%, which if we go back up here all the way up, so the rollover amount, somebody rolled over 600,000. Remember that they got 3.15 million enterprise value, and they rolled over 600,000 of that. You come down here, they get 4.7 million, which is bigger than the first sale of the company, and they're getting 8 times their money on the money that they rolled over. So my sales pitch to the sellers are, you keep doing what you do, which is running a great accounting business. I'm going to keep doing what I do, which is go buy a bunch of other companies and put them together. You're going to run them for me. And then when we get enough scale, we're going to sell it, and we're going to exit it. And I only show them this. You're going to make 4.7 million. I don't show them my 20 million, but I show them the 4.7 million. And then, for them, it's like, hey, I rolled over 600 grand. I get back 5 million. I sold my company the first time for 3 million, 3.15. I'm getting 4.7 the second. Hey, that's a good day. You know, and so I would tell you, JT, it's like I can build this model with no money down. But what happens is that 20 million is going to go away. It's going to become 12, you know, and I'm going to give 8 million to somebody because somebody's got to put up the money. Either I've gotten equity from someone or I've got a lot more debt that needs to be paid off and debt that needs to be serviced. But absolutely, you can become an 8-figure entrepreneur with no money and doing one of these mini roll-ups and having no cash. You know, as long as I buy the right kind of company and the right kind of industry, and I'm very disciplined, only buying good companies run by good people. I do good diligence. I pay fair market value. I don't overpay for companies. And as long as I do that, I could change this model around to where no equity came in and it became debt. And then all of that equity, which was 1.8 million, is now serviced as debt, you know, and or I sell equity and I bring in some friends and other people. And now I got to service their, you know, their equity. But what winds up happening is if I don't put any equity in at all, I just moderate my returns. And so all I'm really doing is, hey, there's a ton of lenders out there. You know, I have to start calling some of these lenders and saying, look, I'm going to buy a business. This is what the headline price is going to be. Here's what the debt structure is going to look like. And I want to understand your underwriting criteria. You know, I'm going to have a 3-to-1 debt coverage ratio, cash flow to the debt to service the loan. What kind of a down payment are you going to require on me? You know, maybe I'm a veteran, maybe I'm a female-owned business, maybe I'm a minority-owned business. There's a lot of programs out there that will help, you know, so I have to see if I qualify for any of that kind of stuff. And, you know, under SBA guidelines, I might be able to find, you know, a lender who says, look, I'll underwrite this, you know, but I just need you to come out of pocket with something. Give me 50 grand, give me 100 grand, you know, and so I could go max out a bunch of credit cards if I wanted to, you know, not telling people to do that. Please don't go run out and do that. But, you know, it's like, I could take a home equity line. I could get friends and family to say, let's put together a little, you know, a little pile of money that we can put in, and I'll give you a return. I'll give you a piece of the equity action. You know, there's a lot of things that we can do creative. You know, for a guy like me, if I put in 1.8 million and I'm going to get a 20 million plus return on an 11 times multiple of invested capital, that's a good deal. Now imagine I do this, JT, not once, but I do this 4 times. So I get one going, I pick another industry, I get another one going, I pick a third industry, get another one going, pick a fourth industry, get another one going, and then 3-4 years down the road, exit, 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 exit. 20 million times 4 or 5 of these, you're a 9-figure entrepreneur.
So on the next episode, and that's why you have to subscribe and comment and like, we're going to talk about, you may not need any money to do this because you can be creative, use the company's money, use another investor's money, but what skill does it take? And this show is not just for people who want to put it together, but how does your company fit? Because if you're at $1 million in EBITDA and you want to get to 4 million, so you can exit to 28 to 32 or $35 million, you have to spend a lot of money in marketing. And the best way to do that is to merge or acquire, which we're going to talk about what are the skills required to do this on the next one. If you want to do this with me and Adam or learn how we do what we do, ideally, we'd like to do it with you or your company or show you how you do it so we can do deals. This is why we do this podcast. Make sure you like, subscribe, comment. Make sure you have the link in the bottom, adamcoffee.com, and let's do some deals. And we're doing many deals together. We're working on a lot of different deals, and not only just in America, but all over the world, doing a lot of stuff in Australia right now. But this is possible all over the world, but you need the right people, the right knowledge, the right system, and the right people doing the right things in the right order, which we'll do that as well. Also, Adam and I are going to be at Mega Success, which is pretty much the world's most successful people and A-list celebrities and billionaires in one room doing it all together as well. Thank you so much. Link in the comment, chat, like, subscribe. Adam, we will see you on the next one. So it's going to be very shortly thereafter. So make sure the more you guys comment and share, the more we're going to do this too. We'll see you on the next show.
Take care.